Welcome back to the Global Ledger. I'm Justin. In the last few episodes, we explored how collateral spreads and global dollar liquidity shape the modern financial system. Today, we're going deeper into one of the most powerful and you could say even dangerous forces in markets, leverage. Leverage is not just borrowing. It's not just, call it margin, and it's not just, quote, using debt. Leverage is a balance sheet extension, a way for institutions to take a dollar of equity and turn it into $5, $10, or $50 of market exposure. But leverage is never free. It has a price, it has a structure, it has a cycle. And understanding that cycle, understanding the price of leverage, is one of the clearest ways to understand how markets boom and why they sometimes break. Let's get to it. So, what is leverage? Most people think leverage is borrowing money to invest. And okay, yep, true, right? But I would argue that leverage is the act of expanding your balance sheet by taking on liabilities to acquire assets. If your assets grow more than your liability costs, you profit. But if your asset falls or your funding costs rise, well, you lose. So leverage is a simple equation with massive consequences. Return on assets minus cost of funding equals return on equity. So small changes in either side of those can really change everything. So I want to lay out three components to the price of leverage. Number one, funding cost. So how much you pay to borrow, repo rates, as an example, credit spreads, margin loan rates, and swap rates. So if funding is cheap, leverage expands. If funding is expensive, leverage contracts. So that's number one. Number two, haircuts. Collateral requirements. So how much collateral you must post. So if haircuts are low, you can borrow more. If haircuts rise, well, your leverage collapses instantly. So haircuts rise with volatility, uncertainty, credit risk, and collateral quality concerns. So number three, I would say volatility, risk premium. This is your lender's demand when safety is needed more. As an example, when volatility spikes, markets panic, correlations are kind of becoming unfragmented, and liquidity dries up. So these three together create, in my opinion, the true price of leverage, not just the interest rate. So let's map out some of these leverage cycles, and I'll break this down into basically four phases. So phase one, low volatility, cheap leverage. Okay, dealers expand, hedge funds increase size. That's one. Margin requirements are low, risk taking grows, asset prices rise. Okay, phase one. Phase two, rising valuations, more confidence. So collateral values rise, haircuts start to fall, funding becomes easier, balance sheets start to stretch. So starting to see where we might be going next. Phase three, a shock hits. So this is volatility rises, lenders demand more collateral, funding costs increase. Phase four, forced deleveraging. So assets are dumped, prices fall, collateral looks worse, haircuts rise again, more selling. So this is the leverage spiral. So the exact mechanisms behind long-term capital management in 1998. Let's see, the tech bubble, 2000, the housing crisis of 08, March 2020, the Treasury blowout. and even recently in the UK in 2022. So leverage doesn't just amplify cycles, it really does create them. So really the key insight here is leverage is a function of liquidity, not risk appetite. So textbooks do teach that leverage is about risk tolerance, expected return, investor psychology, but in the real world, leverage expands when liquidity expands and contracts when liquidity contracts. Dealer balance sheet capacity, collateral quality, and funding spreads dictate the ability, or I should say availability, of leverage. So not attitudes and not fear and greed, just strictly mechanics. Where's the Fed's role in this stuff? So backstop, and so when leverage collapses, the modern financial system loses the ability to function. So because treasuries stop trading smoothly, credit spreads start to blow out, risk premiums explode, the discount rate spikes, valuations crash. So the Fed steps in not to save markets, but to stabilize funding. And this is through repo operations. This is through QE, dollar swap lines, collateral backstop, standing facilities, regulatory relief, right? So when the price of leverage becomes disorderly, the Fed can restore order. Not because it wants to raise asset prices, but because the system cannot clear without functioning leverage. So let's talk about leverage and valuation. I think this is kind of something hidden. So the discount rate rises when leverage becomes expensive. It falls when leverage becomes cheap. Okay? So think about it. When funding spreads widen, discount rates rise, valuations fall. When haircuts rise, funding collapses, discount rates jump. So when volatility spikes, hedging becomes more expensive, which results in these discount rates surging. So I think this is why valuation cycles follow liquidity cycles, and earnings sometimes don't matter. And I think this is why macro surprises can be overwhelmed by funding stress. So and this is why fundamentals fail to explain short-term moves, because leverage is the silent driver of valuations. And when you know that and you understand, or you at least look at it differently in this way, markets can stop feeling random, and it can start looking like physics, not chaos. So leverage is one of the most mechanical, structured forces in finance, and it's visible if you know where to look. So thank you for listening to episode 19 of the Global Ledger. We broke down leverage quickly, but we're going to go deeper into this as we start expanding. So understanding these little nuances of leverage will come clear if it's not clear already. Episode 20, we're going to talk about why liquidity can vanish instantly, and this is we're going to take a look behind the microstructure of market crashes. Once again, I'm Justin, and thanks for being here.